Welcome to the Nadex Application and Strategy webinar series presented by Daryl Martin from apexinvesting.com. Today we're talking about trading a binary straddle on Nadex. Now with most binary companies out there, you actually can't trade a straddle. You can only do up or down. But with Nadex, you can actually do a straddle, which gives you a huge advantage for trading things like the news. And what we're going to do is we're going to go through an example of a trade on oil before and then after the oil inventory report comes out. So when you do a straddle, you want to take into account a few things. One is timing. When you think the market will move. So when do you think the market will move? Well, around news, such as the oil inventory report. And then how far do you think the market will move? So that's where something like an implied deviation level or diagnostic deviations like we use come in, or you could use other methods that you may find useful on figuring out how far you expect the market to move. And then when you're picking your binary strikes, you're going to want to take into consideration risk and reward. So ideally you want a target goal of 1-to-1 for a risk-reward ratio or better. So for example, for every $20 at risk, you expect the market to move fast enough and far enough for a potential profit of $20. So if you make $20 on a risk of $20, that's a 1-to-1 risk-reward ratio. Now there are a lot of places to get access to news. One example, you could go to our website, or we have economic indicators built in there. Here's another example from forexfactory.com showing the crude oil inventory report. It comes out at 10:30 a.m. Eastern Time or 9:30 Central Time every Wednesday. In this example, it shows that the inventory report expects that crude oil will actually be 2 million barrels higher than it was in the previous week. Now, if there's even more crude oil, then there'd be an expectation that there's an abundance of supply, therefore the price would drop. But if the actual number comes in lower than the forecast, then that'd mean a drop in crude oil inventories, therefore we'd expect the market to rise. Well, since we don't know what is going to come out on the report, one of the things we can do is we can put on a straddle. So if the market goes up or down far enough, then we can actually make a profit on this oil inventory report. So we know when we expect the move to happen and what we expect to have the move happen on. We expect it to happen on oil at 10:30 a.m. Eastern Time. But how far do we expect it to move? And that's where something like deviation levels come into play. So if we zoom in on the oil inventory deviation levels, we can find that there's an expectation that oil will move basically up or down about $1.78, so $1.50 or so. So $1.50 above where the market's at or $1.50 below where the market's at is the expectation of movement on oil on this particular day. Now we could trade it even tighter. We could go for only a half deviation level. So by going for a little less than a deviation, then we're going for the probability that there's less than a 32% chance that oil will break out of a 1 deviation level. So being $1.78 higher or $1.78 lower, there's less than a 32% chance of that based on deviations using implied volatility. So with all that being said, we need to now find strikes that are basically less than $1.78 above and below the market. And this chart here is the oil contract on this particular day where we see that oil is just basically going in a little consolidation range waiting on the oil inventory report to come out. And what we've done is we put a line about $1.50 above and $1.50 below where the market's at, because that is within the 1 deviation range up or down on the market. So step one is you want to buy a binary within the expected move. So how far do you expect it to move? You want one that's lower than that, okay? That you believe has enough time to allow the market to move the expected distance. Therefore, you're going to buy a binary at a strike that's above the market but below the expected move. So now we want to find a binary that is below our expected move but above the market. And so we can look on the Nadex price order, we find a binary at a strike of 88. Well, the market's at 86.50. So with the market being at 86.50, we go ahead and decide to buy the 88 strike binary. And the cost could vary, $10, $20, etc. And when you're trying to figure out the risk on a binary, the Nadex platform will tell you when you open a ticket, but also another easy way is if you're buying a binary, the difference between the price you buy it at and zero, okay, is going to be the risk. So if you bought this binary at $10 and the floor is zero, then the difference between 10 and 0 is $10. Therefore, your risk on this leg of the straddle would be $10, expecting that if the oil inventory report comes out with a lower than expected inventory, oil could rise as high as $88. Now, since it's a binary, we need to have 2 legs to the straddle, so we also need to sell a binary. And we're going to go in and we're going to sell one that is below the market. And we want to combine all of them together so that way the combined total has a 1-to-1 risk-reward ratio or better. We'll talk about that more here in a second. But again, we want to sell a binary at a strike below the market. Again, the market's at 86.50, and we have an expected move of $1.78. So there's actually a binary that's $1.50 below the market as well. So it's great when you can straddle them with sort of an equal distance on both sides, and that works out. And so let's say we sell this binary at $90. You could have sold it at a little higher, a little lower, but if we get it on this binary at $90, we sell it. Now when you're selling, okay, this can be a little confusing, but when you're selling, the risk is going to be $100 minus the price you sell it at. So $100 minus 90 is $10. Therefore, the risk on the trade would be $10 for the sold binary. So now we have a risk of $10 on the bought binary and a risk of $10 on the sold binary. And therefore, we can make money potentially if the market moves far enough, fast enough on the way up or the way down after the oil inventory report. Now remember, you want a risk-reward ratio of 1-to-1 or better. So if you combine both binaries' risk together, in this instance, $10 on the bought binary and $10 on the sold binary, then your total risk is $20. Therefore, you should have an expectation that oil will move far enough that you could recover your original $20 at risk on one of the legs of the straddle, making a profit of $20 total. All right, this next step is probably the most important step when you're doing a straddle, or really when you're doing any binary trade, is you want to insert a take profit order on both the bought and the sold binary as soon as they're filled. So as soon as you see them in your open positions, immediately you want to insert a take profit order. This is really easy to do. It's 3 simple steps. Click on the green arrow next to your open position, then simply adjust the price for what you want to take profit at, and then click on place order, and that'll submit the order. Okay, so we know we want our risk-reward ratio to be 1-to-1. So if I'm risking $20 total, $10 on the bought binary, $10 on the sold binary, I need my net profit to be $20 in order to have a 1-to-1 risk-reward ratio. I understand that one leg ideally will profit and the other leg will most likely lose. So I need the profitable leg to not only make the $20 I'm originally risking in profit, but also to make the $10 of the losing leg, because I don't plan on getting any of that money back. So I need a total profit on the profitable leg to make $30. So how do I do that? Well, I go and I insert that advanced limit order. Well, the one that I bought at $10, if I sell it at $40, then I'll make $30. And the one that I sold at $90, if I buy it back at $60, then I'll make $30. So I put those take profit orders in, then if the market moves far enough, then one side or the other could profit $30, covering the original $10 risk plus the net $20 difference, giving me a net result of a 1-to-1 risk-reward ratio on the trade. So the crude oil inventory report came out. You could be watching a news website, or I can show you directly where to get the link to it. And the expectation was 2 million barrels of increased inventory over the previous week. Well, the number came in a lot higher than expected, 5.9 million barrels of increased inventory over the previous week. Now with that, the expectation would normally be supply has increased, therefore price should drop. And again, this is a weekly oil inventory report, comes out at 10:30 a.m. Eastern Time, 9:30 Central Time on Wednesdays. Now occasionally it comes out on Thursday if there's like a holiday on a Monday. It's released by the Energy Information Administration, EIA.gov. And if you actually want to see the posting of the report, just go to this link right here, ir.eia.gov/WPSR/WPSR summary.pdf. If you go to that link, then this is the report you're going to see. And this link updates with the new report every week. And if you go about 3 paragraphs down, what you'll notice in that first line there, that's the number we're focusing on. The U.S. Commercial Crude Oil Inventory Report says that oil inventories increased by 5.9 million barrels from the previous week. Remember, we saw that over on the Forex Factory website. 5.9 million barrels was the actual number, but the expectation was 2 million. So now the reports come out, and if the market moves far enough and fast enough within the time frame of the binary that you're trading, then the advanced limit order should be filled and the trade will be profitable. Note, if the report comes in close to expectations, like almost exactly at or just barely off, then the market may not move that much, and you may decide to go ahead and just close out both sides of the trade to minimize the loss. Now, the worst case scenario, if you leave the trade on until expiration and the market stays flat, the most you're going to lose is the original $20 risk, and of course not including exchange fees. So now let's take a look at what happened with the market when the oil inventory report came out. So we know the market was right about 86.50 right before the report came out there at 9:29 Central, 10:29 Eastern Time. And oil came out. The report came out. We know it came in higher than expected. Oil began to drop and dropped pretty fast, pretty far for that day, and came back down, actually touched our sold strike. So the strike that we bought, since oil went down, the binary strike that we bought that said oil would be greater than 88, has basically become worthless. And we can't do anything with it, and we just leave it there. Okay, so we lost the $10 on the bought side of the straddle. Okay, now on the sold binary, remember the inventory report came in much higher than expected, therefore more oil, therefore oil drops in value. So since oil went down as we saw, then this binary decreased in value. Well, since we sold it at 90, we can now buy it back at a cheaper price at 60. If I sold it at 90 and bought it back at 60, that means I made $30. If that's confusing, just think about it in reverse. If I bought it at 60 and sold it at 90, I'd make $30. The only thing that's happening here is I'm selling first and buying second. Either way, so long as I buy lower than I sell, then that's a profit. Now remember, we lost $10 on the bought binary. Remember, because it dropped down, the bought binary became worthless. So the profit on this straddle trade as a whole was $20, and the risk was originally $20, making the risk-reward ratio total on the trade a 1-to-1 risk-reward ratio. Now, there are three things that you want to remember whenever you're looking to do a straddle trade. So, when do you think the market will move? Like before a news report, such as oil inventories, unemployment claims, there's a lot of different reports out there. And the distance, how far do you think the market will move? So, whatever method you want to use for that, support, resistance, deviation levels, there's a lot of different ways to figure that out. I use deviation levels. You can use whatever way that you want to. And then the third thing is make sure you take into account your risk-reward ratio. You really want to look for binaries and profit targets that give you the potential goal of making a 1-to-1 risk-reward ratio or better. For example, every time you risk $20, the potential to make $20 on the trade is within your expectation of how far the market will move. And a summary of the steps on the straddle. Buy a strike above the market and sell a strike below the market. Then immediately enter the take profit order on both sides as soon as you get filled on your entries. And then if the market does not move as expected, you have the option to leave the trade on to lower the loss on the trade. Or, you could just hold on to it, and then, the worst thing that's going to happen is you're going to lose, the $10 or $20 you put on each side. Now, if the take profit order is filled and the trade is profitable, you could leave the other side on because the market may bounce back up and see if it becomes profitable before expiration. Or you could even edit the existing working order for that $30 profit you had on originally just to get out of that leg at break even. So if the market just bounces up some, you might be able to even get out at break even to recover the risk on the losing leg, making your net profit higher on the total straddle trade. So again, buy strike, sell strike, enter take profit order. Those are the three main things. So to try this out, open a live or a demo account. Just go to nadex.com today. You can click on Create Account in the top right corner. Also, under Our Products on Nadex, you can see Open a Demo Account. So just click on Our Products to open a demo account or create an account. Also, visit us at apexinvesting.com, and I'll teach you more about how I trade Nadex and show you the tools and the things that I use to help me trade the Nadex markets.